valuations. In part one of this video, we looked at the dividend growth model and we also looked at the DCF model for valuation. I want to move on and look at relative valuation techniques. So this is a valuation methodology where one asset derives its value relative to the market price that the market is willing to pay for that. I said if you want to buy a car or you want to sell your car, one of the things that you look at is you go to different car dealers and you look for a car that's similar to yours, probably the same model, with probably the closest year and probably the closest mileage. It can give you an indication of how much you can sell your asset for. That's exactly that we're doing with companies. The companies in the auto industry, we look at other companies that are in the same industry, what valuation have they managed to attract, and we can use that as a basis. So it's simple and it's related to market prices and it's grounded on sound economic principles and it's also widely used and recognized. So what is the essence of a relative valuation? Find comparable assets, that is in this case companies, and obtain market values for the assets. Convert the market values into standardized values. In this case we call those price multiples. You see that the use of multiples becomes important because that becomes the driver. Control for difference between your firm and asset and your comparable asset. So you begin to compare what is the difference between the one that I'm using as a comparable asset and my asset, and you can now make the necessary adjustments. So these are the 3 steps that you need to follow, and it becomes simple. So when you talk about multiples, you're talking about identify comparable companies, calculate the average median multiple, and adjust for differences based on the company fundamentals. So in this case, the fundamental that we're going to be looking at is the multiple that you've multiplied by that company fundamental, and I'll explain that as you see. So the first one that we use the price to earnings ratio as a way of comparing between two companies based on the price earnings ratio. Like maybe just to start with, what is the PE ratio? It's calculated as your share price divided by your earnings per share. So this gives us, I think, just to interpret this, it's a measure of the confidence that people have in the company. In other words, how much price are people willing to pay for $1 of earnings? The more confident people are with a company, the more they're willing to pay for the same $1 of earnings. Now, so the PE ratio, we begin to look at the PE ratio of different companies and use that now as our multiple, and we begin to apply to our company. So in this case, when we rearrange the company, we're saying the value of the company becomes your PE multiplied by your EPS. So what we're going to do in this case is we're going to look at the PE ratio of a comparable company, just like what we said. We look at a comparable company and then we begin to adjust for it to arrive at our own PE, and then we multiply by the earnings per share for our company, and that's how we arrive at the valuation of our company. Very simple process. So this is best to use for non-controlling interest and obviously for profitable companies because you're using earnings per share. And the drawback is that you cannot use it if your earnings are 0 or they are negative. Key things to note here. So the value drivers is the estimation of your price earnings as well as the calculation of your earnings per share. Now, just PE ratio and other fundamentals. Proposition 1. Other things being held equal, higher growth firms will have higher PE ratio than lower growth firms. So if I'm looking at my company and the proxy company that I've done, say for example, I want to value XYZ hotels and I've used African Sun as a proxy. If African Sun has got a PE ratio of 15 and I'm saying my company is growing at a rapid rate, so the adjustment is going to be, I'm going to add on that PE. Higher risk firms will have a lower PE ratio. Again, I'm going to compare the risk between the two companies. For example, if my own company is overborrowed than African Sun, I'm going to adjust my PE downwards. Other things being held equal, the higher return on equity, the higher the growth and the higher the PE ratio. So there's another fundamental that you look when you're comparing between the two companies. So when you look at what company can I use as a comparable company, it should have similar cash flows, similar risk, and similar growth. But however, sometimes it's not easy to find. So when you're comparing between two companies to find out, the closest one is the one that you're going to take. You also can use peer group multiples, which is same industry, similar business mix, similar size, similar age. Consider companies in other countries as well. But one thing that I want to emphasize, whatever you do, you can never use a comparable company that is in different industries. So the starting point is always a company that is in the same industry. Although the companies could be different sizes, but you can never compromise on them being in the same industry. So now these are areas that you're gonna adjust for. These are things that you adjust for. So you're looking at growth, historical growth, product life cycle, chosen strategy, efficiency, asset turnover. You look at risks, luxurious goods, operating leverage, product service diversification, liquidity, marketability, country risk, debt, equity, interest cover, and beta. Then you apply financial ratio analysis to identify also the difference, particularly when you're comparing performance. So that's the adjustment that you're going to make on the PE. Now just to look at the adjustment on the earnings, one thing that you want to do is we want to calculate what we call maintainable earnings, which means what earnings can be generated into the future. There are things that affect our earnings and make them not maintainable. For example, this year we might sell a building and realize a huge gain on disposal. The profit that's coming from a gain on disposal is not sustainable because we don't expect to be selling buildings every year. So the starting point is to look at the trend in historical earnings. If the trend is stable, where earnings are very stable, use the most recent earnings. If the trend is growing, use the most recent earnings, and you can adjust your PE for expected growth. Or you can even use a weighted average with heavier weight on the more recent earnings. If it's cyclical, normalize your earnings, which means you can average earnings over the most recent cycle. And then if it is erratic, you can try and average over a longer period of time. So these are some of the adjustments that you need to do on your maintainable earnings. Right, earnings due to other funders but not included in earnings, for example, preference dividends. This you might want to take them out because you can value preference dividends separately. Also adjust for non-recurring items, gains, asset impairment, goodwill impairment, provision for future losses, as well as changes in accounting estimates. Also, non-operating earnings, you might want to value these earnings separately. For example, if they're coming out of investment property, take them out and value the investment property separately. Owner-occupied property, you might want to charge rent to the business and treat the owner-occupied property as an investment property. And you might want to also adjust for the difference in accounting between comparable company and our own company as well. Right. I think when you look at also private company adjustments, transactions which are not at arm's length are the adjustments. For example, there might not be a salary for the owner, and we are saying if you buy the business, there will obviously be a salary or above market salary for market family members. You'll have understated expenses for loss-making business, private expenses in company account, expenditure on private use assets, excess entertainment, related party adjustments, loan to family, below market. So that's some of the adjustments that you can do to arrive at your maintainable earnings. Right, so that's the price earnings ratio. This next one is you're looking at your price to book ratio. Again, price to book ratio is share price divided by net assets value per share. So this one also shows the confidence, how much, what is the price that people are willing to pay for $1 in net assets value that you have. You rearrange the formula, you get your price to book multiplied by the adjusted book value. So this is your accounting value, in this case, based on your balance sheet. So the price to book ratio is what you're going to use based on the comparable company. You go through the same process like we did for price earnings ratio to look for a comparable company. You look at their price to book ratio and you begin to adjust, and then you multiply with our adjusted book values. Price to sales ratio, again, the same principle. Our multiple is your price to sales ratio. Comparable company multiplied by our sales. Remember, it's still maintainable sales going into the future, and we get the value for our business. Price to cash, exactly the same principles that you follow. What is the price to cash ratio based on a comparative company, and you compare it with a company and you value based on that. So whatever model I give, I can give you enterprise value over EBITDA is the principle still remains the same. What is our, like in this case, our multiple becomes your EV over EBITDA. For a comparable company, and then multiplied with my own EBITDA to get the value of the enterprise. Look, I can give you any multiple. You should be able to apply the same principles when you're doing your own valuation. Right, just to wrap up valuations, asset-based valuations. This is where you're going to use the balance sheet to value the company, and you're going to individually value the companies as if the assets are going to be sold separately, and then you come up with a value based on the balance sheet. These are book value assets. Just adjust them to market value, what you could get if you're going to dispose of the assets. Please don't forget the deferred tax implications when you do that. So you use this in your value for liquidation, fair value for accounting, for IFRS, sum of parts valuation, investment in holding companies where you've got a holding company that has got multiple subsidiaries, so you're going to value the subsidiaries separately and then add them up. So assets within the business must be separable if you're going to use this. There are certain assets that you can never separate from the process that are ongoing, and assets should also must have a standalone cash flow. One cash flow is the ability to be sold separately, and there should be an active market for similar assets. So when you look at the valuation approach, use all other valuation models for individual assets, i.e. DCF, relative valuation. For asset, determine the most appropriate valuation model. So you can also use it for companies that are in distress with little chance of survival, where you talk about the liquidation value per share and you compare that with the current share price. The liquidation becomes the total worth of the company's physical assets when it goes out of business. Like we said, applies to relative valuation for the different assets, for the liquidity discount. Then you can have your ordered liquidation, which gives a bit of time to identify the buyers, or you've got forced liquidation where there is a time. So in this case, you're going to use discounted values. Right, I think these are some of the principles for intangible assets. Some of them cannot be separately identified, things like goodwill, patents, trademark, intellectual property. So some of them can actually end up having a zero value. Obviously, listed investments, you can dispose them separately. Property, plant and equipment, working capital and cash. These are some of the assets that you may need to think about how best to value them. Value of liabilities, talk about the seniority of debt, any agreements that are linked with creditors in the process, and then normally your trade suppliers are the last to be paid. So that's it on valuation of companies. Hopefully you benefited from this later. Thank you very much.